If you dumped silver this week, you didn't T-sell volatility, you sold the bounce. Because the moment the last weak hand hit the button, silver turned around and spiked up 32% in a single session. And suddenly the same people who were screaming, "Bull market is dead," started whispering about $100 again. That is what happened. A fast shakeout, a hard snapback, and a fresh signal from the Fed that changes the whole playing field. Now watch this. While we were observing price whip around, the real story was hiding in plain sight. The market just got a hint that rate cuts aren't. T a maybe, they re a setup. And when rates roll over, silver doesn't T politely rise, it lunges. So let's talk like we re in the same room, looking at the same screen, trying to not get played by the same tricks. We re here to measure, not gamble. And yes, this is educational. We manage risk. Here is the punchline. The headlines won. T say out loud. The people who panic sold into Thursday. S drop basically handed their position to buyers who were waiting for that exact moment, because Thursday wasn't T, the end. Thursday was the trapdoor. Silver slid hard, about 32%, and the mood flipped instantly. You saw the red candles, you saw the fear posts, you saw the told you so crowd do their little victory lap. Then Friday happened. Silver ripped back higher, pushing toward a strong weekly gain. And the entire complex, metal, miners, the big silver tracking ETF, moved like someone flipped a switch. So what changed in 24 hours? Did the world suddenly run out of silver on Friday morning? Did inflation vanish overnight? Did the economy magically heal? No, the flow changed, and the Fed signal hit at the same time. Let S start with the macro spark, because this is where most people get it backwards. Fact, the latest jobs data came in weak, with payroll growth far below what the crowd expected. Interpretation, that kind of miss tells policymakers the engine is losing torque. And when the engine loses torque, the Fed doesn't sit on its hands, it starts cutting. A Fed official floated the idea that we could see around 150 basis points of cuts ahead. That is not a tiny tweak, that is a policy turn. And policy turns are oxygen for precious metals. Basis points sound boring, but they re-a-weapon. 1 basis point is 0.01%. So 150 basis points is 1.5%. If policy rates drop that much, it is not just cheaper borrowing. It is a shift in how every asset gets valued. And silver is hypersensitive to that shift, because silver is a confidence meter. When real yields fall, cash feels less safe. When real yields fall, people stop asking, why hold metal? They start asking, why trust paper? Now, we also need to watch the gap between paper price and real-world tightness. If spot drops but physical premiums don't, T-budge, that is the market whispering this drop is fake. If spot drops but inventory dries up, that is the market shouting this drop is fake. So don't T-stare at the chart like it is a slot machine. Look at the plumbing. Availability tells the truth when headlines lie. And here is the next open loop. Everyone talks about silver like it is one thing. It is not. It is two markets in a trench coat. There is the paper market that trades promises, and there is the physical market that trades atoms. Most days they move together during stress. They fight. And when they fight, weird things happen, like price dropping while demand is rising. That is when opportunity shows up. Now let's talk miners for a second, because a lot of us use miners as leverage to silver. Miners are not silver, but faster. They re-businesses with costs, politics, and operating risk. So when silver rises, their margins can expand like a rubber band snapping back. That is why miners can outrun the metal. But the reverse is also true. One rough session in silver can punish miners like they committed a crime. So we don't treat miners like a toy, we treat them like an amplifier. If we size it wrong, volatility forces us out at the bottom. So here is a simple discipline. Metal is the core. Miners are the satellite. Excitement is optional, survival is not. Now a hard question, if your whole plan depends on never seeing red, do you actually have a plan, or do you have a fantasy? Markets don't. T-reward fantasies. They reward people who can take a hit and still think clearly. That is the edge. And the next test is coming. Next week, we show us who trades reactions and who trades reality when tape gets violent. Because silver doesn't pay interest, cash does, treasuries do. Money markets do, so when rates are high, holding metal feels like carrying a backpack full of bricks while everyone else is riding a bike. But when rates start falling, the bike slows down, that opportunity cost shrinks, and suddenly owning metal stops feeling expensive and starts feeling like the simplest hedge in the room. Now here is the mistake most people make. They hear rate cuts and they think it is bullish only after the cuts arrive. Wrong. Markets move on expectations. They move on the shift in probabilities. So the moment traders start believing cuts are coming, capital begins to rotate, and silver is one of the first doors that money tries, because silver is not just a macro trade, it is also an industrial metal that sits inside real demand. Solar, electronics, medical, defense, grid upgrades. Every time the world electrifies one more corner, silver gets pulled into the wiring. So when liquidity gets easier and industry keeps pulling metal, you get a squeeze that doesn't need hype. It needs math. Now, if we're honest, we all felt the punch on Thursday. Price fell, media got loud, and the emotional part of the brain starts screaming, get out before it gets worse. But here's the contradiction. If Thursday was proof the rally is over, why did Friday immediately erase a chunk of that damage? Why did buyers show up like they had a calendar reminder? Because they did. A big part of the selling pressure was mechanical, index rebalancing, and forced flows that have nothing to do with smart money changing its mind. It is not a thesis, it is a schedule. Robots sell because the rules tell them to sell. Then the pressure ends, and real buyers step back in. This is how markets steal coins from impatient hands. They don't always crash you. Sometimes they just nauseate you until you quit. So ask yourself this: did we sell because the story broke, or because our stomach did? Now we need to talk about what is next, because the next two data points are where this turns from nice bounce into new regime. First, inflation data lands on the 13th of January. If inflation prints softer than expected, the market will lean harder into cuts, that is rocket fuel for metal. If inflation prints hot, we may get another shake. But even then, watch the logic. Hot inflation doesn't automatically kill silver. Sometimes it strengthens the reason people want hard assets. The real question is how yields react, and that is where the battle is, because yields in the dollar are like gravity. When they rise, metals feel heavier. When they fall, metals feel like they're refloating. So we watch the reaction, not the headline. Then we hit the next central bank meeting on the 27th of January and 28th. That is where the market listens for confirmation. Not promises, not vibes, confirmation. And confirmation is what turns maybe $100 someday into the market is actively walking there. Now let us address the $100 number, because it sounds insane until you realize how fast silver can move when it catches a bid. Silver doesn't climb like a staircase. It behaves like a spring. You compress it with forced selling. You lean on it with paper pressure. You make everyone think it is tame. And then it snaps. When it snaps, it doesn't ask permission. It gaps, it runs. And the people who sold because it felt scary end up chasing higher because now it feels safe. That is the cruel loop. So what would make the spring snap harder? Cuts a weaker dollar, falling real yields. And a market that realizes demand isn't slowing while supply isn't magically expanding. We don't. Need a conspiracy. We just need a bottleneck. Now, we also need to be credible here. Possible risk. If the dollar surges and yields climb, silver can get slapped around again. That can happen, and it can happen fast. But here is the part most viewers miss. Volatility is not bearish by itself. Volatility is a tool. It is how big players shake out leverage. It is how they test conviction. It is how they find sellers. So if we can handle a 3% down day without panicking, we will keep donating our entries to people who can. We don't have to be heroes. We just have to be disciplined. Now, let us zoom into the vehicles a lot of people use to play silver because it matters for the flow. The big silver ETF is basically a pipe. When money pours in, it has to source metal. When money pours out, it can pressure the complex. That is why ETF flows can amplify moves. It is not just price, it is plumbing. And when price jumps and rate cut expectations rise, you often see that pipe turn on. More buying, more demand, tighter availability. Then the narrative follows after the move. Again, expectations first, headlines later. Now here is the uncomfortable question we need to ask ourselves. If silver can rip this hard on a single policy hint, what happens when the policy shift becomes official? What happens when cuts aren't forecasted? They re-delivered. What happens when the market starts front, running the next cut and the next one and the next one? That is where $100 stops sounding like clickbait and starts sounding like a magnet, not guaranteed, but plausible. And we should talk like adults about how to play it. We pick a plan, we size positions like we respect risk. We don't over leverage because we reshore. We watch the catalysts, we watch the reaction function, we stay in the game. Because the worst outcome isn't being wrong, the worst outcome is being right and still missing it because we bail during the shake. Now let me show you the psychology trap, because it is the same every cycle. Day 1, price drops, fear spikes, everyone calls it the top. Day 2, price bounces, everyone says dead cat. Day 3, price grinds, people get bored, they quit. Day 4, price explodes and the same crowd screams, why didn't I hold? This is why we don't trade emotions, we trade structure. We trade conditions, and right now conditions are leaning in a direction metals tend to like: slowing growth pressures, policy. Easier policy weakens the cash advantage. Industrial demand stays stubborn. Supply doesn't respond quickly. That is the setup. So what do we do with Thursday, S-drop, and Friday? S-rip, we don't. Worship it, we learn from it. We remember that forced flows can create fake weakness. We remember that headlines love drama, not accuracy. We remember that the market's job is to make us doubt ourselves at the worst time. And then we decide, are we building a position or are we day trading a mood swing? Now, I want you to watch one more thing because it is the tell. When silver sells off, check how quickly it finds buyers. Does it bounce violently? Does it reclaim levels like nothing happened? Does it keep attracting dip buying? That is not random, that is demand. And demand doesn't speak in interviews. It speaks in footprints. Now, we're coming into a window where those footprints could get bigger. Inflation data, central bank messaging, a market that is already sensitive after a sharp week. That is a perfect environment for another shakeout and another squeeze. So here's the move we need to make as a community. Stop letting one day define the trend. Stop letting a mechanical flow convince us the thesis changed. Stop mistaking noise for signal. If we re-wrong, we see it in the data. Yields ripping higher, dollar strength persisting, policy turning hawkish again, and silver failing to hold key supports. That is where we reassess. But if that doesn't happen, if cuts stay on the table, if growth keeps cooling, if liquidity eases, then every dip is the market offering inventory, not advice, inventory. Now, before we go further, I want to pull you into the conversation. If you were watching silver on Thursday, what did you feel? Anger, fear, or confusion? And be honest, did you buy the dip or did you freeze? Drop it in the comments, because the real edge isn't just charts. It is seeing how we react under pressure, and while you are down there, hit subscribe. Quick, because the next few weeks are going to move fast, and we're not missing the signals now. Back to the $100 path, because there is one more layer people ignore. Silver doesn't need perfect news to rally. It needs the market to realize the old framework is breaking. High rates can last forever when growth slows. A strong dollar can stay strong if the Fed turns dovish faster than others. And when that pivot hits, silver tends to reprice in bursts. It is not a gentle repricing. It is a sudden one, and that is why Thursday's shake matters. It showed us where sellers were hiding. It flushed them. It reset sentiment. And then it gave buyers the clean runway to push again. So when people ask, why did it bounce so hard? The answer is simple. It wasn't just a bounce. It was a vote. The market voted that the dip was temporary. Now, here is the cliffhanger we need to sit with. What if this week wasn't a one-off? What if it was the first tremor before a bigger move? Because the next inflation print could pour gasoline on the cut narrative, and the next central bank meeting could confirm it. And if that happens, silver doesn't have to try to go higher. It gets pulled higher. So keep your eyes on the reaction. Keep your plan tight. And don't let the next red candle scare you out of a trade that is built on a policy shift. We're not here to be entertained by chaos. We're here to make sense of it. One last question, because it matters more than any price target. If silver hits $100, what will you regret more, buying too early or selling too soon? Tell us below and stay close, because the next headline won't warn you before the next jump. It will report it after it is already gone.